Have you ever wondered how professional traders decide when to buy or sell currencies to make a profit? Today, we are going to explore the different strategies people use in the currency derivatives market, specifically focusing on speculation. Let's start our journey with speculation, where traders take a bold view on the market with the goal of making a profit. For our first case study, imagine a trader who believes the Indian economy is doing well and inflation is dropping. Because of this, they expect the INR to get stronger, moving from 83 rupees to 81 rupees over the next 6 months. To act on this view, the trader shorts 100 lots of a 6-month USD-INR futures contract at 83.90 rupees. By the time the contract expires, the price has dropped to 81.20 rupees. Since the settlement price is lower than the price they sold at, the trader earns a profit of 2.70 rupees per USD. With 100 contracts of 1000 USD each, the total gain is a profit of 2,70,000 rupees. Building on that idea, sometimes traders expect a currency to lose value instead. In our second case study, a trader sees international tensions and rising crude oil prices, leading them to believe the INR will weaken from 83 rupees to 85 rupees. They decide to go long, which means buying 500 lots of 3-month USD-INR futures at 83.10 rupees. When the price hits 85.30 rupees at expiry, the trader makes a profit of 2.20 rupees per USD. This results in a total gain of a profit of 11 lakh rupees. Now that we understand basic speculation, let's move on to more advanced strategies like cross trade and premium trading. If a trader thinks the USD will weaken against the euro, they can buy EUR USD futures. They can also use cross rate arithmetic, where the EUR INR price is found by multiplying the EUR USD rate by the USD INR rate. Additionally, if a trader expects prices to stay steady, they might try to capture the forward premium. Since USD interest rates are often lower than Indian rates, USD INR futures usually trade at a premium. By shorting these futures, when prices are flat, a trader can earn a profit equal to that premium. Beyond simple futures, many traders prefer to use currency options for their strategies. If you are bullish and expect the USD to rise, you could buy a USD INR call option or sell a put option. If you are bearish, you might buy a put or sell a call. While selling options can be attractive because you do not have to pay an upfront premium, it is very important to remember the risk. Selling options exposes a trader to a potential unlimited loss while only offering a limited profit. While speculators take risks on where the market is going, arbitrageurs look for something very different: price mistakes. Arbitrage involves finding a difference in prices between two markets and trading in both at the same time to lock in a profit. For example, if a 6-month future is trading at 83.25 rupees, while the forward price in the OTC market is only 83.816 rupees, a trader can sell the expensive future and buy the cheaper forward. This locks in a profit of 0.09 rupees per USD, no matter what happens to the market price later. Building on the concept of arbitrage, there is a more complex version called triangular arbitrage. This involves looking for price gaps between three different currencies like the euro, the USD, and the INR. For instance, if you start with 1000 euros and trade them for USD, then for INR, and finally back to euros, you might end up with 1002.67 euros. This gives you an arbitrage profit of 2.67 euros. These opportunities are rare and disappear quickly as traders rush to take advantage of them. Now, it is important to realize that arbitrage is not entirely without danger. Real-world risks include execution or time risk, where the price moves while you are still setting up your trades. There is also liquidity risk, which could leave you with a risky naked position if one part of your trade does not go through. You must also consider settlement differences and transaction costs like brokerage and taxes, which can quickly eat away at small profit margins. If you are looking for a strategy that focuses on the relationship between two different contracts, you might consider spread trading. A spread is simply the price difference between two futures or options. Movement in these spreads is usually driven by things like interest rate differences, how much money is in the banking system, and big policy decisions from the RBI regarding repo rates or the CRR. Success here requires a deep understanding of how interest rate parity works. One of the most popular spread strategies is the calendar spread. This is where a trader takes opposite positions in contracts for the same currency but with different expiration months. For example, a trader might sell March futures at 83 rupees and buy April futures at 83.20 rupees, creating a spread of 0.20 rupees. If that spread grows to 0.30 rupees, the trader makes a gain of 100 rupees per contract. To make this easier, many exchanges offer a special spread order facility to help avoid the risk of prices moving while you place your orders. Now that we have covered the strategies, let's look at the hurdles that traders, especially those trying to protect themselves, might face. The first limitation is standardization. Because contracts have fixed expiry dates, there can be a date mismatch if your actual business need matures on a different day, leading to what we call basis risk. There is also a size mismatch. Since the standard lot size is 1000 USD, an importer who needs exactly 10,500 USD must choose between being underhedged at 10,000 or overhedged at 11,000. Building on those constraints, we must also consider settlement and duration. Exchange traded currency derivatives are cash settled, but many businesses actually need the physical currency delivered to them. This can lead to a loss of value if the timing or price of the cash settlement does not perfectly match the real world transaction. Furthermore, these contracts are usually only available for up to 1 year, making it very difficult for a company to protect a long-term 5-year loan. Even with these limitations, exchange traded derivatives remain a very popular choice. The transparency of the market, the ability to trade in small lot sizes, and the flexibility they offer are huge advantages. Most importantly, the clearing corporation guarantees that every trade will be settled, providing a level of safety and ease that often outweighs the minor mismatches in dates or amounts. Following the rules set by FEMA, the RBI and SEBI ensures that these powerful tools are used responsibly by everyone in the market.